Payal, and I am from the Management Study Guides content team. Welcome to the course Corporate Governance. Look at the news that made headlines in all the leading newspapers across the world. Satyam Computers involved in one of the greatest frauds of the business world. Let us see what really happened. Satyam Computers is a reputed software firm of India with around 185 Fortune 500 companies as customers and operations in 66 countries. Satyam Computers had on December 16, 2008 announced that it will acquire two group firms, Metas Properties, Metas Infra. The board of directors of Satyam had approved the founder, Bairaju Ramalinga Raju's proposal to buy 51% stake in Metas Infra and 100% in Metas Properties. The total outflow for both the acquisitions were expected to be $1.6 billion, comprising of $1.3 billion for 100% stake in Metas Properties and about $0.3 billion for 51% stake in Metas Infra. This is the point that sparked a row over alleged violation of corporate governance laws. The deal was not profitable to the investors. Hence, after this announcement, the investors started raising a hue and cry. The promoters decided to inflate the revenue and profit figures of Satyam. Hence, the company had a huge gap in its balance sheet. So, Satyam Computer Services Limited got involved in a multi-million-dollar accounting fraud which ultimately led to a huge face loss for the entire Indian IT industry. The involvement of the reputed external agency like PricewaterhouseCoopers (PwC) in the scandal made the entire episode a nightmare for the regulatory bodies, the government, and the employees of the organization. Therefore, it is very critical that every corporate should follow the norms of good corporate governance. The objective of corporate governance is the prevention of such scams in businesses which have a huge bearing not only on the immediate shareholders but also on the morale of the large stakeholder groups. Corporate governance is basically a detailed disclosure of information and an account of an organization's financial situation, performance, ownership, and governance, relationship with shareholders, and commitment to business ethics and values. Let us learn about corporate governance in detail. Let us understand the objectives of this course. Explain what is corporate governance. Define corporate governance. Explain what is a corporation. Describe the features of a corporation. Explain what is good corporate governance. Explain the Sarbanes-Oxley Act. Describe the role of government in corporate governance. Describe the World Bank directives for corporate governance. Explain the factors directing corporate behavior. Describe the emerging best practices of corporate governance. Explain what is corporate social responsibility. Explain the role of board of directors in corporate governance. Describe the benefits of corporate governance. List the principles of corporate governance. And list the rules of corporate governance. Number 2. Corporate governance ensures transparency, which ensures strong and balanced economic development. The Sarbanes-Oxley Act of 2002 is also known as the Public Company Accounting Reform and Investor Protection Act in the Senate and Corporate and Auditing Accountability and Responsibility Act in the House, and more commonly called Sarbanes-Oxley SARBOX or SOX. It is a United States federal law created by U.S. Senator Paul Sarbanes, Maryland, and U.S. Congressman Michael Oxley, Ohio. It was signed into law on July 30th, 2002. Let's take a look at morality and accountability of corporate decisions. It is a fact that it is hard to establish the accountability and responsibility of corporate decisions. You have seen that there are certain expectations of the communities from the corporate. Also, there is a certain level of trust and agreement, whether written or otherwise, which exists between the corporation and these constituents. These agreements are sometimes between the corporation and its employees, suppliers, creditors, and while some other agreements are imposable by the legislature. Corporate has to base its decisions keeping the below parameters given by World Bank in consideration: transparency, independent oversight, accountability. Some of the factors that drive corporate behavior from the perspective of good corporate governance are such as follows: profit, corporate social and environment responsibility, consumer preference, absence of regulations and rules. Let us look at each of these in detail. Let's take a look at corporate social responsibility, also known as CSR. In the context of corporate governance, CSR means that corporations have to take into account society and the environment as stakeholders and cater to their needs instead of just pursuing profits at the expense of everything else. The Shiksha movement is dedicated and stands true for its motto, Padhega India, Badhega India, meaning educated India, progressive India. The following are the golden rules of corporate governance practice. Ethics. Business should be carried out on a clearly ethical basis. Alignment of business goals. A proper stakeholder decision-making model should be used to reach appropriate goals. Organization. The structure of the organization should promote good corporate governance. Strategic management. An efficient and effective strategy process should be implemented which incorporates stakeholder value. Reporting. Transparency and accountability should be propagated through a properly structured reporting system. With every course, you get to view the course content online, download the PowerPoint presentation, and get the course completion certificate. With new courses added regularly, we offer you a continuous learning platform. Join our premium membership plan and get access to unlimited courses. All our plans are backed up by 30-day money-back guarantee. If you are not completely satisfied, we'll give you a full refund. We are so confident that you will enjoy the membership that we are willing to let you try at our risk, not yours.